Okay, let's unpack this. What makes a luxury brand truly powerful, enduring, not just for years, but for centuries? What's the magic behind that exclusivity, that status, that sheer desirability?
That really is the core question, isn't it?
Yeah.
And today, we're taking a deep dive into, well, the undisputed heavyweight champion of that world, LVMH, Moët Hennessy, Louis Vuitton, SE.
Right. And to get to the bottom of what makes this giant tick, we've pulled from your stack of sources, it sounds like a really comprehensive business quality analysis covering everything from their huge brand portfolio and financials to real world customer experiences. And even I saw insights from alleged former employees.
Yeah, exactly. Our mission here is basically to cut through all the noise and extract the most important nuggets of knowledge. Think of this as your shortcut to being genuinely well-informed about, frankly, one of the most fascinating companies out there.
So you'll hear one of us bringing the curiosity, maybe highlighting the surprising facts, the stuff that makes you go, wow.
And the other will provide, the calm analysis, trying to connect the dots and help you understand the bigger picture, the so what behind it all.
As we explore this, think about what resonates with you, what really stands out from this material we've looked at.
So what is LVMH? Fundamentally, it's less a single company and more like a sprawling, decentralized empire. Really, it's a collective of over 75 distinct Maison or houses, each with its own history, its own identity.
Wow, 75.
Yeah. We're talking iconic names like Louis Vuitton, Christian Dior, Tiffany & Co., of course, but also global retailers like Sephora and, legendary names in spirits like Moët and Chandon and Hennessy.
That's just an incredible breadth of brands. It covers so many different facets of luxury and, consumer desire. And your sources break this empire down into 5 key segments. Is that right?
Exactly. There's the absolute core powerhouse.
Yeah.
Fashion leather goods. That's the big one. Then you have selective retailing, which includes distribution channels like Sephora and DFS. There's watches and jewelry, perfumes and cosmetics, which often serve as kind of entry points into the luxury world for people. And finally, wines and spirits, tapping into, centuries of heritage.
So how does a business like this, selling things most people, frankly, only dream of, make such enormous amounts of money?
Well, the model is almost elegant in its simplicity. They sell high-quality, high-margin products at premium prices. Simple as that. But that ability to command those prices, it isn't just marketing fluff. It's rooted in deep history, that perceived exclusivity, painstaking craftsmanship, and a really powerful cultural resonance tied to each specific brand.
Let's look at the scale for a second, according to your 2024 numbers.
The sheer scale is mind-boggling. We're talking $84.7 billion in revenue, with $19.6 billion in operating profit.
Huge numbers.
Huge. But dive into fashion and leather goods specifically. $41.1 billion in revenue, contributing a staggering $15.2 billion in operating profit.
Wow.
So that's nearly half the group's total sales, but it accounts for almost 78% of the profit. It just underscores how absolutely vital Louis Vuitton, Dior, and that whole segment are to the group.
So they're not just selling, handbags and champagne. They're selling something intangible.
Precisely. The enduring core of LVMH is selling status, beauty, heritage, and art de vivre, as the French say. They tap into these really fundamental human desires, the drive for social signaling, aspiration, self-expression.
Things that aren't going away.
Exactly. These desires aren't temporary fads. They seem deeply embedded in the human psyche. They're not disappearing in our lifetime, that's for sure.
And that inherent human drive. That explains why the business is so resilient, right? Even when the economy gets shaky.
It's a major factor, yeah. Luxury is just less exposed to typical economic downturns because its primary customers, high net worth and ultra high net worth individuals, are simply less affected financially.
Their spending doesn't fluctuate as much.
Right. And beyond that, LVMH benefits from the structural multi-decade growth of the global affluent class, particularly in emerging markets. Your sources highlight a forecast, I think, for the overall personal luxury goods market growing at something like 3.2% compound annual growth rate through 2028.
I found the description of their organizational structure really fascinating, this decentralized model they use.
It's absolutely crucial and maybe a bit counterintuitive, but it's a huge part of their success. Bernard Arnault, the leader, famously calls it a federation of medium-sized companies.
Right.
The whole philosophy is to grant each Maison significant autonomy, independence. It's designed to preserve their distinct identity, their creative spark, their entrepreneurial spirit.
So it stops them becoming this giant, slow bureaucracy.
Exactly. It actively combats the kind of bureaucracy you'd expect in such a massive group, protecting the creative magic, as they say, at the local level. This structure itself is a competitive advantage.
Which brings us neatly to the competitive fortress, the economic moat, as analysts call it, around this business. What's the primary source of that protection?
Well, the deepest part of the moat, undoubtedly, is those intangible assets, that portfolio of truly iconic brands. These aren't just commercial entities, they're practically cultural institutions.
You mean the history?
The history, absolutely. Moat and Chandon, established in 1743, Hennessy in 1765, Louis Vuitton in 1854. You simply cannot replicate centuries of history overnight.
Yeah, you really can't just manufacture that kind of heritage, can you?
No way. As Bernard Arnault himself has apparently said, American brands do not have the mythical dimension that Dior or Louis Vuitton have. These have a history the Americans don't have. And that history is the source of their extraordinary pricing power and those high margins we talked about.
Okay, so that's the qualitative side. Is there quantitative proof?
Definitely. Look at market share. In 2022, LVMH accounted for over 42% of sales among the top 10 global personal luxury goods companies. That's dominance.
And to make that pricing power really concrete, let's look at the Louis Vuitton Speedy handbag. This example from the sources really shows the moat in action, financially speaking.
Oh yeah, it's a perfect case study. The Speedy started out as a travel piece back in the 1930s. Now follow its price over time. It was around $150 in 1979, then $430 in 2002. It jumped to $1,000 by 2018 and hit $5,550 by 2023. And your sources noted further increases of like 4 or 5% planned for early 2025.
That's price appreciation far, far beyond any normal inflation rate.
Absolutely. This sustained ability to dramatically increase prices without, meaningfully hurting demand, that just proves the strength of the brand moat. Customers aren't just paying for the canvas and leather. They're paying for the history, the status, the sheer desirability of that LV monogram.
Yeah.
That price tag is the financial outcome of all that intangible value.
So based on all this, the history, the scale, the pricing power, the moat's trajectory looks incredibly strong, right? Widening even.
Well, on the surface, yes, it appears stable, potentially widening. Their scale gives them formidable advantages, like securing the absolute best retail locations globally.
Prime real estate?
Exactly. Possessing an unrivaled marketing budget. I mean, they even partnered with the Paris 2024 Olympics. And they have this systematic M&A playbook to acquire and integrate desirable brands, like they did with Tiffany.
There's always a but, isn't there? Your sources include a really important caveat here, something that challenges this seemingly invincible picture.
Yes, and this is where our deep dive into your sources uncovered something potentially quite significant that the wider market might be overlooking. The moat, while obviously built on historical prestige, ultimately relies on the current day-to-day reality of the customer experience.
Okay.
If the actual experience of interacting with the brand, buying something, getting service, doesn't consistently live up to that luxury promise, that desirability, which is the true source of the moat, can actually begin to erode over time. Which brings us to the scuttlebutt.
Right, the scuttlebutt. Love that term. Going beyond the official reports and financials to see what people are really saying and experiencing on the ground, what did your simulation of that reveal?
It revealed a pretty stark and, frankly, quite concerning dichotomy in customer sentiment.
Okay, dichotomy how?
Well, on one hand, there's undeniable product love. No question about it.
Meaning people love the actual items.
For sure. Customers express deep admiration for the core brands, the design, the heritage, the status they confer. Your sources showed Christian Dior with a very strong Net Promoter Score of 53.
Which is good, right?
Oh yeah, very good. Anything above 50 is considered excellent.
Yeah.
It indicates high levels of promoters and loyalty. We saw notes from long-term Tiffany owners praising the durability of their jewelry. There's often a genuine emotional connection people feel towards these brands.
But then there's the other side of the coin. What your analysis calls service loathing.
And loathing feels like the right word sometimes. Based on the sources, it seems widespread, and the descriptions are scathing. Looking at public complaint forums, the Better Business Bureau, Consumer Affairs for brands like Louis Vuitton, Dior, and Tiffany & Co. reveals hundreds, maybe even thousands, of deeply negative accounts. And they particularly center around the post-purchase and online experience.
That's interesting. So not the initial buying in the store necessarily.
Less so, although there are some issues there too. But the online side and what happens after you've paid seems to be where a lot of the frustration lies.
What kind of complaints are people making about these, ultra luxury brands? This isn't what you expect.
No, it isn't. Horrific online customer service seems rampant. We saw reports of customers spending hours on hold, dealing with unhelpful or sometimes outright rude representatives, getting caught in these frustrating bureaucratic loops trying to solve simple problems. Then there are significant failures in just basic shipment and quality control. Examples like a, $400 Louis Vuitton perfume arriving completely shattered, a Louis Vuitton bag delivered with a major flaw in the strap, even something like a Dior lotion bottle inexplicably delivered with no pump mechanism.
That is genuinely shocking for products at this price point. You expect absolute perfection or close to it.
Exactly. And the complaints then extend to what sound like nightmarish return and exchange processes. Customers reporting being unfairly denied legitimate returns, being falsely accused of damaging items themselves,
Oh, wow.
and having returns rejected without any clear explanation. Some descriptions use terms like unethical and illegal, which is, a universal way from a seamless, frictionless luxury experience.
Definitely.
And maybe most concerningly, some accounts mention poor initial product quality. Things like Louis Vuitton bag handles allegedly becoming sticky or melting after a while, logos oxidizing strangely, pearls in a Dior ring peeling off after only a few wears. Issues that just should not be happening at this level.
And this isn't just isolated to the highest end brands, right? Your notes mention similar kinds of issues even popping up at Sephora.
That's right. Even their sort of mass-market beauty retailer shows patterns of complaints, lost packages, incorrect orders, unhelpful customer service. There were even reports of loyal, high-spending Rouge members feeling they were treated poorly. So this pattern of operational friction, it seems to appear across different parts of the empire, different price points.
So if these quality and service issues are real and seem fairly widespread based on the complaints, what could be the potential root cause? Your sources looked at the employee perspective here, didn't they?
Yes, exactly. Digging into anonymous accounts from alleged former Louis Vuitton retail employees offers a potential and quite troubling explanation. These accounts consistently describe a toxic, extremely high-pressure sales culture.
How so? What does that look like?
It sounds like an intense, almost singular obsession with hitting sales targets. Allegedly, management is perceived as being only about sales, constantly changing targets and exerting immense pressure on the retail staff. And this pressure seems to create really misaligned incentives. Employees reportedly feel pushed to prioritize selling high-commission items like exotic leather bags over genuinely addressing what a client actually needs or wants.
So upselling over service?
Potentially, yeah. There were even claims in the sources of some employees allegedly refusing service altogether to clients interested in lower commission items, like the classic monogram canvas pieces.
Wow, that's bad. And the alleged culture itself, beyond the sales pressure.
Also described pretty negatively. Terms like toxic positivity, intense and unethical competition among colleagues, things like trying to steal clients and sales from each other, management being dismissive of employee issues, and HR allegedly often siding with management during disputes. One really striking quote in the sources describes some retail managers as seeming dead in the soul.
Oof. Okay, now I can really see how this connects back directly to those customer complaints. If employees are operating under that kind of intense pressure with those kinds of incentives, it directly explains why the customer service experience, especially post-sale, could be so poor.
It absolutely does. It raises this really worrying possibility that the company might be accumulating what you could call operational debt.
Operational debt, what do you mean by that?
It means they could be leveraging the immense prestige and desirability of their brands that historical equity to potentially underinvest in, or perhaps just poorly manage crucial back-office functions and customer-facing roles.
Right.
This might boost short-term profit by, say, cutting customer service costs or pushing sales volume at absolutely all costs. But it comes at the expense of creating these disillusioned, sometimes really angry customers. And as you noted, this stands in stark contrast to Bernard Arnault's publicly stated uncompromising focus on quality.
And the risk here long-term is pretty obvious then.
Yeah, operational debt can lead to permanent brand damage. If the reality of interacting with an LVMH brand, the post-purchase headache, the quality issue you have to fight over, the frustrating return process, if that consistently fails to match the aspirational dream the marketing creates, that essential desirability, the magic, will erode. It has to.
Okay, let's shift gears a bit then. Let's talk about management stewardship and the overall financial health of the company, because this is an area where, at least on paper, the picture looks incredibly strong based on your sources.
It really is. You can't separate the exceptional quality of this business from its leadership. There seems to be this rare combination of creative sensibility, real operational rigor, and truly rational capital allocation happening at the very top.
And Bernard Arnault has been the chairman and CEO since 1989. That's over 3 decades. What are the core tenets of his philosophy, based on what the sources say?
His philosophy seems deeply rooted in long-term thinking, a really almost uncompromising focus on quality above short-term profit. He's quoted saying things like, "Profit is a consequence of what we do well. It should never become a goal. And money is just a consequence. If you do your job well, the profitability will come." It's all about building enduring value in these Maisons for generations, not just next quarter's earnings.
And that decentralized structure we discussed earlier, that's a key part of his philosophy too.
A huge part, yes. That federation of medium-sized companies approach is specifically designed to actively reject central bureaucracy. It's about empowering individual brand leaders to be essentially entrepreneurs within the group, fostering independence and agility to protect that creative spark we talked about.
Keeps things nimble.
Exactly. He also apparently fosters what's been called a productive paranoia, this idea of being permanently dissatisfied, believing that nothing worse than complacency. It drives continuous improvement. It's really a classic, highly effective owner-operator mindset focused on the very long term.
And their track record on capital allocation, how they spend their money. It looks like a masterclass in rational decision-making from your notes.
It truly does seem that way.
Right.
They consistently reinvest billions back into their Maisons. I think the figure was $5.5 billion in operating investments in 2024 alone. That goes into expanding and renovating stores, upgrading production facilities. This is absolutely vital for maintaining their physical presence and ensuring quality control over production.
And they're famously known for smart acquisitions, M&A.
Yeah, M&A seems to be a core competency for them, not just something they dabble in. They appear to have a systematic playbook for identifying, acquiring, and integrating new brands effectively. The Tiffany & Co. acquisition back in 2021 for nearly $16 billion was a huge strategic move to significantly bolster their watches and jewelry segment.
Right.
And importantly, they demonstrated remarkable price discipline during the uncertainty of the COVID pandemic. They actually renegotiated a lower price for Tiffany, saving the company around $500 million. That kind of clear-eyed focus on value, even in a huge deal, is really the hallmark of a rational capital allocator.
And do they return capital to shareholders as well?
Yes, absolutely. They have a long and consistent history of paying dividends. The proposal for 2024 was 13.0 per share, which represents a very sustainable 52% payout ratio of their earnings. And that dividend has grown impressively over the last decade. They also use share buybacks, but seem to do so opportunistically rather than systematically.
So if we apply a sort of rationality test based on everything the sources indicate,
the evidence overwhelmingly confirms that management appears rational, highly disciplined, shareholder-friendly, and driven by a genuine long-term owner-oriented mindset. This leadership quality is undeniably a key reason for the company's historical quality and enduring success.
and you see this quality reflected clearly in the financials described in your analysis as a financial fortress.
Absolutely. It really is a reliable earnings machine. It generates consistent, substantial profits, even through varying economic cycles. In 2024, for instance, their operating margin was 23.1%. That's still above pre-pandemic levels, and it follows even stronger years recently. This high, stable profitability is the direct quantitative result of those powerful brands and that incredible pricing power we discussed.
Let's look at a couple of key quality ratios mentioned in the sources. Return on invested capital.
Yeah, ROIC, which basically tells you how effectively they use the money invested in the business to generate actual profits, has been consistently excellent. We're talking double digits for over a decade. In 2022 and 2023, it exceeded 13-14%, and even in the slightly slower 2024, it was around 11-12%.
And that's good compared to their cost of capital.
Crucially, yes. It's consistently above their estimated weighted average cost of capital, or WACC, which your sources put around 10.4%. This means they are consistently creating real economic value year after year, not just accounting profit. Free cash flow conversion is also prodigious. They turn a huge portion of their reported net income into actual cash available to the owners. That signals a highly efficient, relatively capital-light business model despite the store investments.
And the balance sheet itself, you called it a fortress.
Fortress-like resilience, truly. Net debt was only about $9.2 billion at the end of 2024. Now, for a company this size, that translates to an exceptionally low net debt to EBITDA ratio of about 0.33x.
Wow, very low leverage.
Extremely low. This gives them a massive margin of safety. It allows them to comfortably weather any economic storm and also gives them the firepower to invest aggressively or make opportunistic acquisitions when competitors might be struggling.
Okay, so we've established undeniable business quality here. Incredible brands, visionary leadership, best-in-class financials, a deep protective moat. Which brings us, inevitably, to the critical question for any potential investor: price versus value. Given all this quality, is the current market price actually attractive?
Right, that's the multi-billion-dollar question, isn't it? As of mid-2025, when this analysis was done, the market was valuing LVMH at a pretty significant discount compared to its recent historical valuation.
How much of a discount?
Well, the trailing price-to-earnings ratio was running around 18x to 20x. And the price-to-free cash flow multiple was somewhere between 17x and 23x. Now, to put that in perspective, their 5-year historical average PE has typically been much higher, somewhere in the range of 26x to 32x.
So investor sentiment has definitely cooled off.
No doubt about it. It clearly reflects the recent cyclical headwinds hitting the luxury market, things like demand normalizing after that huge post-COVID boom, and the recent softening we've seen in demand from China.
So, on the surface then, it might look like a classic opportunity. You're getting a truly great company at a much cheaper price than usual.
That's certainly the typical interpretation you'd hear, and it's perfectly understandable. The market appears to be pricing in those cyclical slowdown factors. So if you believe these are just temporary issues, that demand will inevitably rebound strongly, then the current price looks, reasonable, maybe even quite attractive for a long-term hold.
Your qualitative analysis, especially digging into that scuttlebutt stuff we talked about, really complicates that simple view, doesn't it?
It really does. Based on the deep dive into the sources, particularly those real-world customer and employee experiences we discussed, this current discounted price might not actually offer enough margin of safety for a truly multi-decade investment horizon.
Why not?
Because the long-term strength of that moat isn't just about history and brand recognition. It's critically dependent on delivering a superior current experience. The evidence we saw, suggesting potential structural issues, the poor customer service, the quality control problems, points to a risk that the market doesn't seem to be fully recognizing or pricing in.
So, your crucial judgment here, boiling it down, Kate.
I'd say the price might be fair if you only consider the widely understood cyclical risks. Everyone knows luxury slowed down a bit, but is arguably not attractive enough to compensate for these potential qualitative structural risks to the moat, that our analysis highlights risks that don't seem to be widely recognized by the market consensus. It's not just about a temporary cyclical downturn. It's the potential for these operational issues to fundamentally undermine the very source of their long-term value.
Okay, that makes sense. Let's talk specifically about the growth potential then, and also the permanent risks to the business. What's the primary engine driving future growth for LVMH?
Well, the most powerful underlying driver is almost certainly the long-term secular expansion of global wealth. Just the sheer increase in the number of high net worth and ultra high net worth individuals around the world. That's the core tailwind for luxury demand.
And especially in emerging markets, I assume.
Precisely. As economies continue to develop in places like China, India, Southeast Asia, the Middle East, the affluent class expands dramatically. This creates millions upon millions of new potential luxury consumers over time. Your sources cited a Knight Frank prediction, I believe, projecting UHNWI growth of 50% in India and 47% in China over just the next 5 years.
Wow, huge growth potential there.
Yeah. This global wealth creation continuously expands the total addressable market for LVMH's products decade after decade. It's a very powerful long-term trend in their favor.
But what about the risks? Not just temporary dips, but the things that could permanently damage the business, the investment thesis.
Right, the permanent impairment risks. Well, the most significant and perhaps the most difficult to quantify is succession risk, often called key man risk.
Because of Bernard Arnault's long tenure and influence?
Exactly. The extraordinary success and the unique culture of LVMH are undeniably deeply tied to Bernard Arnault himself. He's currently 76 years old, and while his 5 children all hold senior positions within the group,
Right.
There's no publicly articulated clear succession plan. A poorly managed transition after he eventually steps down could potentially lead to strategic drift, maybe internal power struggles, and possibly permanent value impairment. Adding to that, the family holding company structure apparently requires unanimous agreement among the siblings for key decisions, which adds another layer of complexity and potential risk.
Okay, that's a big one. And then there's a risk we already highlighted with the scuttlebutt, the potential for brand equity erosion.
Yes, and this is maybe the most insidious threat because it attacks the very foundation of their competitive advantage, the moat itself. Desirability, that magic quality, is ultimately fragile. If the company consistently fails to deliver on the luxury promise through, say, declining perceived quality, inconsistent craftsmanship, or those frustrating service experiences we heard about, it could lead to a slow, persistent, grinding erosion of brand prestige and trust. If iconic brands like Louis Vuitton or Dior start becoming associated in customers' minds with operational headaches and hassles rather than effortless luxury and quality, that pricing power will eventually diminish, possibly permanently.
And finally, you mentioned geopolitical risk, particularly concerning China.
Yes. The modern luxury industry has become heavily reliant on the Chinese consumer, both domestically within China and as tourists spending globally. Asia, excluding Japan, accounted for about 27.5% of LVMH's total sales in 2024.
Significant chunk.
Huge chunk. So, a severe long-term economic crisis in China or a major geopolitical event, the nightmare scenario being something like a conflict over Taiwan, could permanently disrupt their established growth algorithm. While LVMH is geographically diversified globally, the sheer scale of the Chinese market is simply irreplaceable in the medium to long term if something were to go badly wrong there.
Okay, let's try to bring in some second-level thinking here. What's the prevailing market consensus on LVMH right now? What does the street generally think?
Well, the dominant view among analysts, according to your sources, is generally a moderate buy or buy rating. The consensus largely sees LVMH as a best-in-class company, maybe the best, that's currently facing temporary cyclical headwinds, primarily the China slowdown and that post-COVID normalization.
So they think it's just a blip.
Pretty much. They generally believe these issues are transient, that the fundamental brand strength and the proven strong management team will navigate through them successfully, and that growth will inevitably resume its upward trajectory. So the current, somewhat lower price is often viewed as a reasonable entry point for investors with a long-term perspective. Average 12-month analyst price targets often suggest significant upside, maybe in the 25-27% range from current levels.
But based on this deep dive, particularly the qualitative risks we've uncovered, there's a strong potential for a contrarian view, isn't there?
Exactly. The contrarian perspective, which is really informed by digging into all the source material, including the less glossy parts, is that the market is correctly identifying the cyclical slowdown, but is fundamentally underestimating or maybe even outright ignoring the potential for a more serious structural deterioration of the moat itself.
Why is that view contrarian? What are they missing?
Well, it's contrarian because it takes those thousands of negative customer reviews and those concerning employee testimonials seriously. It chooses to view them not as mere anecdotal noise you'd expect in any huge organization, but as potential data points signaling a systemic underlying issue.
Okay.
The market tends to look at the recent dip in profit growth in 2024 and say, that's purely macro-cyclical. This analysis, however, suggests it could potentially be an early symptom of a deeper self-inflicted problem, namely brand erosion stemming from poor operational execution on the ground.
So the truly important second-level question isn't just about when China recovers.
Precisely. The market is asking, when will Chinese demand rebound? But a potentially more critical question, based on this deeper analysis, might be, look, if an aspirational first-time luxury customer, maybe in China or anywhere, has a terrible first online ordering experience or a nightmarish return process with an LVMH brand, will they ever become the loyal, multi-purchase, high-value client LVMH absolutely needs for its future decades of growth?
Right. The market is focused on the undeniable, glorious heritage.
While the contrarian view, informed by the scuttlebutt, focuses on the potentially increasingly tarnished current reality of the customer experience for some. The key insight the consensus might be missing is the inherent fragility of desirability.
Fragility.
Yeah. They assume the moat is this permanent stone fortress built on centuries of history. This analysis suggests it might be more like a magnificent sandcastle that requires constant, meticulous maintenance in the form of excellent service and flawless quality to withstand the times. And the evidence of poor service we found suggests that crucial maintenance might be getting neglected in places. That makes the current fair market price potentially far less attractive than it appears when you factor in not just the cyclical downturn, but also these potential structural risks to the moat itself.
Okay, so maybe let's try to summarize the core investment thesis here using that bull versus bear case structure that was in your sources. Great idea. Okay, on the bull case side, the arguments for owning LVMH. First, you've got that absolutely unrivaled portfolio of intangible assets. These are irreplaceable brands, deep moats, incredible pricing power, tapping into those really persistent human desires for status, beauty, self-expression.
Second, the exceptional capital stewardship. You have the visionary owner-operator Bernard Arnault at the helm, a proven track record of rational reinvestment back into the Maisons, value-accretive M&A like that disciplined Tiffany acquisition we talked about, and consistent growing shareholder returns through dividends and buybacks. Very rational.
Third, it's undeniably a financial fortress. We saw world-class profitability, consistently high margins, that excellent ROIC comfortably above their cost of capital proving value creation, prodigious free cash flow generation year after year, and a fortress-like balance sheet with incredibly low leverage, around 0.3x net debt-EBITDA.
And fourth, that powerful secular growth tailwind driving them forward. The long-term expansion of global wealth, particularly the growth in the high net worth and ultra high net worth populations, especially in key emerging markets, which continuously expands their addressable market for decades to come. A constant stream of new potential customers.
Okay, powerful bull case. Now, the bear case, the counter thesis, the risks that challenge that rosy picture. First, and maybe most worrying based on our discussion, is that insidious brand erosion risk. The potential growing gap between the luxury promise and the operational reality suggested by all that scuttlebutt, the poor service, the quality control issues, the frustrating returns which threatens to slowly, maybe almost invisibly at first, erode brand equity and pricing power over the long term. Second, the unquantifiable succession risk. The business's phenomenal success seems inextricably linked to the 76-year-old Arnault. The lack of a clear, publicly communicated transition plan, potentially compounded by that complex family holding structure, poses a significant key man risk that could lead to crisis or permanent value impairment once he's no longer leading the company.
Third, there's the geopolitical and macro dependency risk. Their heavy reliance on the Chinese consumer, both domestic and tourist, makes them particularly vulnerable to a severe China-specific crisis or other major geopolitical events that could permanently disrupt their established growth path.
And fourth, potential valuation complacency. While the current share price is certainly below its recent historical averages, it may not adequately price in the deep qualitative risks to the moat's durability that were identified in this analysis. It might simply offer an insufficient margin of safety for investors looking to hold confidently for decades, given these potential underlying issues. The most compelling argument against the purely bullish view, what your sources call the red team challenge, is this really uncomfortable idea. The idea that the company might not currently be nurturing its precious moat through meticulous attention to quality and service, but is perhaps consciously or unconsciously harvesting the brand equity that was built up over centuries, maybe prioritizing short-term financial gains, and mistaking that past prestige for permanent indestructible power.
Yeah, it's a stark alternative interpretation, isn't it? In this view, the frequent aggressive price hikes aren't purely a sign of unbeatable brand strength. They could also be viewed partly as financial engineering to boost margins. The widespread service failures aren't just unfortunate operational bugs. They can be seen as the predictable outcomes of a sales-obsessed culture that prioritizes hitting volume targets over building long-term client relationships. And those allegations of declining quality aren't just accidental slip-ups. They could potentially be linked to subtle cost-cutting measures designed to protect profitability.
And the risk of that path is crystal clear. This kind of approach inevitably alienates the aspirational customer base that's absolutely crucial for future growth. It tarnishes the brand's hard-won reputation over time, and it can drive away talented employees, the artisans and client advisors who genuinely value craftsmanship and service above just hitting a number. The brand's risk shifting, maybe slowly at first, from being perceived as symbols of authentic quality and heritage to symbols of cynicism and pure marketing.
And once that happens, desirability could decline, perhaps slowly at first, but potentially accelerating rapidly if the issues aren't addressed head-on. The scary part is, the strong top-line financials might actually mask this underlying rot for quite a while before it becomes obvious in the numbers.
So the core question for you, the listener, to really ponder after this deep dive is this. Are the thousands of customer complaints and those concerning employee accounts simply the inevitable growing pains you'd expect in any massive, complex, global organization like LVMH? Or are they genuinely early warning signs that the very foundation of LVMH's immense value, that fragile, intangible power of its brands and their core desirability, is being subtly, perhaps dangerously, undermined from within by these troubling operational realities?
Next time you see those instantly recognizable LVMH brands out in the world, whether it's a Louis Vuitton bag flashing by, a bottle of Moat being popped, or someone opening a little blue Tiffany box, maybe take a second. Consider not just the incredible history and the hefty price tag, but also try to think about the reality of the experience they are currently delivering to their customers day in, day out. That potential gap between the long-cultivated promise and the current lived reality might just be the most important factor of all when thinking about the future of this luxury giant.